Good afternoon. Okay, what I would like to do today is first give you a basic introduction to community development venture capital, to tell you what it is and how our funds work. Secondly, to give you a statistical overview of what the industry looks like in the United States. Tell you a little bit about why community development venture capital is a powerful tool for economic development. Then I'd like to bring this a little bit to life and give you an example of an investment that we've made, and we actually just exited that investment, and we actually made a fair amount of money. So this was just a few weeks ago, actually. So I'll tell you about that company, and finally give you some recommendations for Korea and what this might look like here and what would be necessary from the standpoint of both public policy and also private endeavor and social entrepreneurship to try to get something like this started. So first of all, just to tell you what this is about. In many ways, we look like traditional venture capital funds in the private market that invest in businesses. But we have what we call a double bottom line, and I'll tell you about that in a moment. So we are mission-driven funds. In a sense, we are social enterprises. We're social entrepreneurs who operate these funds. And I should say, when I say we, the organization I run, CDVCA, is an association of these funds. So the funds around the world are members of CDVCA. And we also operate a fund that makes investments in community development venture capital funds and also makes some direct investments in businesses, always as co-investors with our venture capital fund. So we operate a fund ourselves. So what is this double bottom line? You think first of the financial bottom line, right? The financial bottom line is the thing at the bottom of your financial statements that say whether you made money or not. And we care about that bottom line, the bottom line, because we have to make money for our investors so that they will invest more money so that we'll be able to continue what we're doing. There's been some talk through this conference about whether social entrepreneurs should be making money or not making money. This is a part of this conference about funds that really do make money, and we seek market rates of financial return, venture capital returns, to provide to our investors so that they will then invest in subsequent funds that we form. So that's our financial bottom line. But then we have a second bottom line. We're looking for businesses that, if they are successful, if they can carry out their business plans, they will create significant numbers of good jobs in lower income communities. And often when we talk about the financial bottom line and the social bottom line, we tend to go like this, right? That if we have strong financial returns, necessarily we have to have low social returns. And then the opposite is true, that if you have high social returns, you can't make any money. And at least in this field, we find that we can achieve both at the same time, that businesses that are successful are the kinds of businesses that create significant numbers of good jobs. They're also businesses that create financial returns for our investors. I would say that's not always true in every kind of social enterprise. You may have a social enterprise that is producing education for low-income children. That probably is not a venture capital investment, but the kinds of businesses in which we invest, where our social goal is job creation, the financial bottom line and the social bottom line work together. On the social side, one thing we pay a lot of attention to is measurement of our social goals. So we try to be as rigorous in measuring our social returns as we are in measuring our financial returns. So we look at job creation. How many jobs are we creating? Who's getting those jobs? Are these available to people without significant job opportunities in our economy? And also we look at job quality. What kinds of wages do they provide? In the United States, we don't have national health care. It's provided through employers. So Do these employers provide medical insurance? Do they provide retirement plans? Do they provide opportunities for training and advancement? Opportunities for employee ownership and wealth building? These are all things that we measure, we keep track of, and of course, like any other organization, when you keep track of things, you tend to accomplish those things. You tend to accomplish the things that you measure. So we measure those things, and that then feeds back into how we operate so that we do a better job at achieving our social mission. And to help us with this, we've actually worked over a period of years with several of our member funds who are leaders in this field in creating something that we call our Measuring Impact Toolkit. So it's a 100-page booklet that really walks through data definitions and the whole methodology for measuring social returns as well as financial returns. In addition to the job creation aspects of our investments, many of our funds have additional goals. So many of them now are involved in the whole sustainable development. In venture capital, we call this clean tech, investing in businesses that produce products that benefit the environment. Generally, companies that produce products that are good for communities and useful for low-income people. We promote the ownership of businesses by women and members of minority groups in the United States, and also businesses that have a variety of good employment practices, and we help those businesses implement those good employment practices. So one way to think about this is if you think about what kinds of businesses does a good society have that provides good employment for a broad range of people, that provides good jobs, we're using our tools of capital to try to create that economy, that kind of positive economy in the United States and in other parts of the world. So just briefly, and I'll go quickly through some of these slides. In the United States, there are 71 of these funds. Collectively, they manage $2 billion, and there are also funds in 16 other countries in other parts of the world, in both the developed world and the less developed economies. This gives you some sense of the recent growth in the industry. This is the number of funds, and this is capital under management. And what happened, you saw it flat in terms of numbers of funds, but dollars under management has gone up recently, and that's because we sort of got rid of some of the less active funds in our database, so the numbers stayed the same, but some of the newer funds were much larger than some of those older funds. So the way our funds work, our venture capital funds, is the same way other venture capital funds work. We have to raise money from other people. And you can see from this slide here, we get a significant amount of our money from banks. There's a law in the United States called the Community Reinvestment Act that requires banks to invest in communities, and this helps us raise money from banks, other financial institutions, wealthy individuals, foundations, so a variety of investors in our funds. They invest in a variety of businesses because they're in low-income communities. They don't specialize in a particular industry. They're generalist investors. I won't go into detail about exits, but venture capital is different from, say, making a loan, where you make a loan and you get, the bank gets a check every month. You make a venture capital investment, and the investment stays in the business until something happens to create the opportunity to get your cash back. And examples of that are, for example, a sale of the company to another company, or a public sale of the stock of the company. And this is statistically the way we have exited our venture capital investments. So why is this important for economic development and a good economic development strategy? First of all, we provide equity capital. And this is very difficult to get, and it's important to businesses. It allows businesses to get through bad economic times, such as the times that we've had recently. It also is the kind of capital that allows businesses to grow. If you're building a new plant or creating a new product line in your business, or maybe you're a startup business, generally, first of all, a bank or another lender won't even give you a loan because you don't have collateral and things like that to support that loan. Plus, you're in the mode of using cash, right? You need more and more cash, and you're not producing income right away. You're spending 2 years to build your plant and to buy all your machines and things like that, and it isn't for another year or two later that you start selling your product. So this is a time that you really need equity capital from a patient investor who's going to allow you to build out your business and then later on take a portion of your profits to help pay for that extra risk that the equity investor has taken on. Equity is very difficult to get, really all over the world. Traditional venture capital is almost non-existent in low-income communities, and the source of equity capital for most businesses, I think. Someone earlier talked about the 3 F's: friends, families, and fools. You typically don't have the rich uncle or the guy you play golf with who's going to provide you some money if you're an entrepreneur in a low-income community. So a dedicated source of equity capital can be very important for low-income communities to develop. The venture capital model seeks out investments in businesses that are going to grow very rapidly. And these are exactly the kinds of businesses that are going to create lots of jobs because they're growing rapidly. Plus, these businesses will tend to have good jobs because they need to attract a large workforce. They'll have opportunities for training and advancement. So these are the kinds of businesses that you want to develop if you're concerned about providing good jobs for people. In addition to providing this equity capital, which is very important, venture capitalists also provide a great deal of entrepreneurial and managerial assistance. So again, very different from a lender. A lender provides a loan and generally then waits for the payments to come in every month. If the payment doesn't come in, then the bank lender goes and forecloses or tries to do something to get the money back. The venture capitalist invests in a business and becomes a partner, literally a financial partner in that business. And typically the venture capitalist then takes a seat on the board of directors of that company, provides assistance in lining up additional financing from other sources, perhaps strategic planning for the company, may even make calls and try to get additional customers for the company. Very involved as a partner with that company. And if you speak to our fund managers, they will tell you that assistance that they provide to their entrepreneurs is as important as the financing that they provide to the entrepreneurs. And this, again, can be particularly important in lower income communities where you don't have a fully developed management team, people with a great deal of management experience. Let me just skip through some of these. Let me give you an example of a company, as I said, that we invested in a few years ago, and we just exited. We just got our money back. And I'll tell you the story of a guy named Mark Wilson. He was the head of the call center at a company called Dun & Bradstreet, a fairly well-known company in the United States. So when the customers of Dun and Bradstreet would call for service, Mark Wilson ran the place where they called, and he supervised all the employees. In 2001, Dun and Bradstreet decided to end their in-house call capability and outsource that. In other words, they would hire other companies to do this for them, which was a trend about 10 years ago. And Mark was about to lose his job, and he said, can I bid for this business? And the people at Dun & Bradstreet said, yes, you've done a great job for us. We'd be happy for you to do that. So he went and found some other companies that he could subcontract to win this contract. And he got the contract from Dun & Bradstreet in about 2002. And at that point, he went to one of our member funds, SJF Ventures, and said, I need some money to grow my business, to get additional business. Every time I get a new contract, I have to train people to service that contract. And I need money, I need cash to be able to acquire different contracts. And our member fund, SJF, considered this. They liked Mark. And one thing they particularly liked about him is his management philosophy was, I say, the best job you'll ever have. So in all of his call centers now, there's a big banner that says, the best job you'll ever have. And he pays above industry wages, provides health insurance, very good training, excellent management practices, and for that reason, he has very low job turnover. Call center jobs are generally very poor jobs. They don't pay well, they're boring, and the average turnover in a call center in the United States is 80%. 80% of the employees that are in the work for a call center at any point are gone before a year is up. Because Mark treats his employees well, the job turnover at RILA is 20%. And what that means is if you are, let's say you have it's a cell phone company and you've hired RILA teleservices to answer the questions of your customers, it means that the person you're talking to has worked at the company for 3 years instead of 3 months and is better able to answer questions. So also what that meant is as many of these jobs were moving overseas to other countries, there was a backlash against that. Some of the customers complained, and particularly the businesses that were looking to provide very high quality services were looking for service providers in the United States. And because of Mark's business model, he got that business, and he was able to grow actually very, very rapidly. And of course, on the social side, we were very happy with this emphasis on good jobs. So in 2005, then, SJF couldn't feed the very rapid growth of this business, so they came to my organization, to CDVCA. We co-invested. We took some of our money, invested it along SJF, and did several rounds of investment. Then in 2007, we were able to attract a large venture capital fund from the outside that started investing millions of dollars in Mark's business. The story is then that a business that when we were first involved in 2005 had sales of $7.8 million. When we finally exited, it had sales of $136 million every year. In terms of jobs, I don't know whether it's listed on the slide, but when SJF first involved, it was basically a startup, 20 employees. When we got involved, 151 employees. When we sold this business, there were 3,500, mostly African-American, low-income jobs. Oh, another thing I did not mention, Mark Wilson is African-American. He and his wife, Shelley, owned this company. So we were also able to promote minority ownership of this business. I didn't put on the slide because I don't think it's something that is public, but this company that when our fund became involved with first in 2002 was basically a startup we sold for $69 million about 3 weeks ago. And obviously we made a lot of money, SJF made a lot of money, Mark Wilson made a lot of money. All the jobs remain now in 4 different call centers in rural Georgia and Alabama, very low-income areas. Continue to employ lots of low-income African-American people, and it was actually sold to another minority-owned company. An Asian man owns this company out in California that purchased the company, so the social return was preserved as well. So let's talk a little bit about Korea. First, I think community development venture capital funds can play a very important role in economic development here. Equity capital is scarce for entrepreneurs all around the country, and the kinds of the combination of financial resources and entrepreneurial resources that community development venture capital funds can provide can be very powerful here in Korea. So how do you start one of these? And CDVCA has actually, my organization has been involved in helping a number of people start these all around the country and to some extent around the world. So we've been through this process many times, and one thing we find is you really need a champion. You need someone, some institution usually, that is willing to work over a long period of time to get one of these started. This may be a community organization, a foundation, university, maybe a part of government, an entity that has credibility in the community and has what I've called here convening power. That is somebody who can pull all the important players in the community around the table with credibility, including investors, including business leaders, government, the small business community that would be receiving these investments, and with the goal of lining up enough capital to be able to attract very strong management, because you really need professional management for these kinds of funds. So a champion that has convening power and also ideally access to money, first of all to pay some of the initial expenses of consultants and business plans and things like that for the fund, and secondly also to be a lead investor. It's very powerful to be able to say, we're going to put some of our money up, we believe in this, you should add your money as well. As I just said, it's very important that these funds be professionally managed by people with strong investment experience, but you also need community development venture capital experience somehow, perhaps from an outside consultant, to help create this social purpose fund so that it's different from a traditional venture capital fund. And I've actually seen a number of instances where we've had managers who seem very strong, lots of strong venture capital experience, but never really understood the second bottom line. So you really need people who are going to be able to understand the financial issues as well as the social issues at the same time. Often a very difficult group of people to find. And also financial and social returns should be very clear at the beginning. I think very often in this business we tend to be a little fuzzy about what kinds of returns we're going to produce, what investors' expectations are, and again, in my experience, I have seen very bad situations where investors were expecting one thing and management was really doing something else, and you don't want investors to be unhappy at the end of the process. What is the role of government? We're in a think tank here that advises government, so that's an important question. Government can often play a catalytic role, and I find this particularly outside of the United States. In the U.S., they're relatively well, although we complain about them, relatively well developed social capital markets. There are a number of institutions that can play this catalytic role. Outside of the United States, I've found this is often government, but we need to be careful. If it is government, we need to make sure that government plays that important role, perhaps provides some capital, but then stands back and allows investment decisions to be made independently by professional management and doesn't interfere in individual investment decisions. So government should play a role of providing what I call intelligent subsidy. One role that government plays in the United States is to allow community development venture capital funds to reach a certain scale. You really need to have in US dollars $15 or $20 million managed at one time, and ideally $30 or $40 million. And it's very difficult to find that much socially motivated capital from the investment markets, even in the United States. So government can supplement private capital in creating a fund that is large enough to operate on an economic basis. It can subsidize access to capital, particularly by subsidizing operating expenses. So sometimes it's just more expensive to invest in lower income communities, in rural communities, and a disciplined subsidy of those kinds of additional expenses makes sense. But you do not want to subsidize things like losses. And the reason is, one reason I think this model is very powerful is it really uses the discipline of the market. It uses market forces to create socially positive results. And you don't want to remove that market discipline. And if you tell people, well, you can invest, but if you lose money, we're going to give you your money back, that removes that market discipline. It removes the power of the investor in making sure that this activity is going to work. Just very quickly, forms of government subsidy in the United States. We have tax credits. We have direct investment alongside private investors. We have subsidy of operating costs. And each of these programs contains at least one or more aspects of that kind of subsidy. So the New Markets Venture Capital Program, and I should back up and say, I was just saying at the break to someone, a very important thing about the way the industry developed in the United States is the industry developed outside of government. Social entrepreneurs created these funds without government assistance. The government then discovered us. Government is always looking for good things to do, and said we'd like to help. And we were able to come to government from a place of strength and say, this is what we are. If you would like to add your resources, we would welcome that. That's something very different from government creating a program and finding people basically as contractors to run that program. So the New Markets Venture Capital Program is an example of that, where the Small Business Administration provides both capital to increase the size of funds and also some subsidy of operating expenses. Rural Business Investment Program uses exactly the same model, but for funds investing in underinvested rural areas. The New Markets Tax Credit provides a tax credit to investors in low-income communities. The Community Development Financial Institutions Fund, run out of the Department of Treasury, again provides supplementary capital to community development venture capital funds and other kinds of social purpose financial institutions. And finally, the Community Reinvestment Act that I mentioned before provides a positive mandate for banks in the United States to invest in lower income communities. It doesn't tell them exactly what to do. It doesn't say you have to invest in this particular fund, but it does say you need to do one of a broad number of kinds of things. So the bank can pick and choose, but it has to do something, and therefore it's easier for us to get investments from banks. And I'll just leave you with this final slide. And this, I guess, is an English expression, born to raise hell. It's like make a difference, change things. Then there's the other guy over here, born to raise capital, and you can decide which we are. I think we're some combination of the two.